what does a pullback look like in a strong bullish market? And there are what areas are not even showing us a pullback at all. So I'm going to break down how these major indexes are looking like, what the discrepancy tells us about our expectations going forward. We're going to look at which sectors did well today, which ones did poorly, and find an opportunity with a typical pullback pattern on the market forecast that we can take advantage of. So let's go ahead and get started. Today is Monday, June the 18th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, thanks for tuning in, everybody, especially those watching for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the logo in the bottom right corner of the video. Click the subscribe button that pops out there. Like tonight's video by clicking the thumbs up icon right down below. Comment on anything that stood out to you. Anything you picked up or anything you learned in tonight's video. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link and subscribe. Follow me on Twitter for more content like this throughout the day. Join our Market Outlook community on Facebook. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. The market forecast remains bullish. You notice as the candle's red today, which means we close lower than Friday's close, but it's not filled in. So that's 2 consecutive days where the candles are red and not filled in. Those can happen during bullish moves, because think about, it's the end of the day is what matters the most. And when your stochastics is bullish, when the intermediate line's high, that means we're closing more towards the highs of the day. It doesn't matter where today's high is compared to yesterday's high, at least according to these types of oscillators. It just matters where we close in relation to that day's high. And the more and more we close in relation to that day's high, that's more positive. And that's why, as bearish as we've been, 3 down days out of 4, and we've been kind of sideways here, not really going anywhere. As bearish as that may seem, the intermediate posture is still up above 93, almost 94. Again, because we're getting these filled in, or these open candles that are red. And you'll get black candles on the bottom. They'll be the opposite. There'll be black candles on the bottom, but they'll be filled in during the bearish moves, during more extended bearish moves. And again, the idea being is it will open up higher. The bulls will come in early, and then the bears will come in late during downward moves. Here, the bears come in early, the bulls come in late. And what matters is, it's like I tell my boys in basketball, it doesn't matter if you start the game, it matters if you finish the game, because the coaches will play the players that they trust the most at the end of the game to win it. No matter whether they started or not. So it's the same thing here. Same principle is, it's who shows up at the end of the day. Is it the bulls or the bears? And obviously we're in a bullish trend. We're still shaded green. The posture's still strongly bullish, and dark green, not light green like it is over here. So we are still bullish from that perspective, but we are pulling, we're having down days, and so not as bearish a down day as it could be. You'll notice too that the pullback got us down to the 23% Fibonacci retracement level, and that's it. And that's a little bit below it on the intraday basis, but we opened above it, and we ended up closing even further above it. So again, as bearish as we may seem, that's the extent of the pullback thus far. Intermediate line or near-term line, it's actually down below 50 for a time today, but because we rallied, it brought it back up. So second day up above 50. 7 to 12 is what you expect the blue line to stay up above in the upper half of the chart. It's got to also get up above 80 to really solidify this bullish posture. So look for that. Until we don't see that, we expect it because of the trend. And when we don't see it, then that's when our expectations start to change. The momentum line dropped a little bit, but again, it's right in the middle of the chart. In fact, both short-term sentiment lines are right in the middle of the chart, which suggests that we're very neutral from a short-term perspective, which makes sense. I mean, look at from 6.6, which was 12 days ago, we closed at 27.72, and today we're at 27.73. So we're about as sideways as we can be with very little movement in between, and that's why we have short-term sentiment right smack dab in the middle of the chart. You take a look at some of these other indexes. The Dow Jones Industrial Average has pulled back a little bit more, down to its 38% Fibonacci retracement, continues to get those long lower shadows. The NASDAQ Composite looks even more bullish. You can see not a red candle today. It was actually a black candle, which means that we close higher than Friday's close. So about, half a point higher. Not very much, 1/100th of a percentage point. Near-term line pulling back was still in the upper half of the chart. That's not very bullish of a high point here on the near-term line. Still setting up for that divergence play with a pullback down to 7,600 that we still haven't gotten yet. And then the Russell 2000, more bullish than all of them, up a half a percentage point. The second consecutive overbought cluster with all three lines. In fact, all three lines are above 96. I mean, that's about, and look at market sentiments, almost above 82. That's about as bullish an overbought cluster as you can possibly get. Again, we're not getting that pullback yet like you've seen. We've had a pretty decent run with the blue line getting above 50. So it still looks like we're still due a short-term pullback that we've kind of gotten on the S&P and Dow on these kind of sideways moves. More so on the Dow, it's pulled back more. The S&P has been really sideways, sitting inside that 23% Fibonacci retracement zone. We haven't got any kind of retracement at all yet on a near-term basis on the NASDAQ, or especially the Russell 2000. The Russell 2000 continuing to show. That doesn't mean we're going to be bearish. You can see we got four these overbought clusters and eventually pulled back, but that's when the whole market pulled back, right? We were a little exuberant during that time frame. So it doesn't mean we have to pull back, but it does show that we are pretty long in the tooth right now, and we're not getting a whole lot of confirmation from these other indexes in terms of being this bullish. So it kind of shows that small caps, that risk appetite might be a little extended here. Quick reminder before we look at the rest of the charts, for 3 clicks, looking for 3 clicks here to let us know you want us to keep doing these videos. One is right here to like the Market Outlook tweet for tonight. It's always embedded on the video down below. You can do it right now while you're watching. Number 2 would be to like the Facebook post for today. And you can see we get far fewer Facebook likes than we do Twitter likes. So let's see how many we get there, because we get a lot of likes here on this would be the third one, a lot of likes here on the blog post as well. Remember, you can join our daily Market Outlook email here. You can participate in the Market Outlook forums here with this link up above the video. And of course, here is some information on a discounted offer that's expiring at the end of this month as we start up our Market Scholars website. So there's a link here, and there's the offer right above it to join our website. All right, back to the charts, and you can see, that today's move, which this is only one day in the weekly candle here, we're still up above a rising 50-day moving average, which is also above a rising 200-day moving average, and the gap between the two is still rising itself. So even with today's drop, still bullish from that perspective until we see something different there. Of course, no death cross yet. That's when you get the unshaded area, so we don't have to worry about that anytime soon, at least. You can see from the 3 green arrows perspective, we now finally have 1 red arrow. And so the last time we had at least 1 red arrow was here, so there's that last low point. And right now we're still kind of, like I said, in that 23% Fibonacci retracement zone of that one. So it'd be a higher low point if we're to bounce up off of here. When you look at the 3 lines of these MACD and stochastics, you see we did come below the 8-day moving average. We're trading right at it and tested the 17-day. So we'll see if that ends up being the bounce that produces the next 3 green arrow signal, which is what we'd expect to see. And you can see the MACD below its moving average. That's what produced the red arrow. Stochastics is also below its moving average, but both lines easily in the reversal zone, like the intermediate line in the market forecast. So yeah, there's some short-term weakness, which is expected, but not trend-changing weakness yet. Not even trend-changing to say that we have a weak bearish posture yet. You can see, make a note of that range here being less than the average right now. When you look at the intraday chart, you can see the last couple of days, and I remember the dividend payment that brought that down there. But here you can see we're trading still in the upper half of the range, lower high and a lower low compared to Friday. not very much of a lower low point. And of course, like Friday, closing, the low was early. The low was right smack dab in the first 10 minutes of the trading session. And then the high was pretty much in the last 10 minutes of the trading session. So, I mean, it wasn't a big range as we saw, but it's that's a bullish pattern. That's only not so bullish because we gapped down to begin the day with no dividend payment there. That's a true gap there. Look at the volume. You can see, remember, the range was smaller than average. The volume was way smaller than the average. So after getting a pretty big volume on Friday, back down to less than average, far less than average. 52 million, you can see, is one of the lower days. We're starting to hit into those summer months, right? They can still be pretty bullish here typically, and they can still be pretty volatile, until about mid-June, mid-July is when we peak in the markets. Volatility peaks at a low point, and then we tend to be more, the VIX tends to seasonally rise heading into, from July expiration to that heading into the October expiration. Speaking of volatility, we'll take a look at that. Here's the chart. You can see with the ATR right now relative to price is below 1%. That's kind of the break-even point for bullish versus bearish. So we're falling. That's bullish. The volume is also low compared to its 52-week range, and we are below that. So bullish from that perspective. And now looking at the volatility index, and you can see the VIX gapping up, but coming back down again, just like we've seen before. In fact, we saw that Friday. You look at the VIX relative to the VXV, and we're still right at the sweet spot for bullishness. So, again, the neutral zone will act as a resistance while we're bullish. As long as we're staying in this area, the support will be down here and resistance will be up here. As long as we're kind of in the middle, then we're going to grind our way higher. So to summarize, the market's still strongly bullish, small caps in particular, and still not getting the pullback on the near-term basis on the Nasdaq or the Russell that we really need to see to be healthy, right? To have the ups and the downs. We are getting on the S&P and the Dow, so I don't expect that maybe the next bounce up in those two to be that 7 to 12 day near-term run until we get more of a pullback across all the different major indexes. But any kind of short-term weakness or pullbacks are not going to be trend changing. They may produce a small, weak bearish posture, but nothing to alter this 2 to 3 month expectation of bullishness, which kind of lines up with the seasonality of expecting a peak in stocks around that mid-July expiration cycle. So tell me what you think with this poll popping out in the right-hand corner. Do you agree with this market posture? Do you disagree? As always, if you disagree, comment down below on anything that you see. I'd love to see different perspectives and different opinions and different evidences that would suggest maybe we're not as bullish in the intermediate term, and maybe we are a little bit more bearish in the short term. So let me know what you think. All right, now let's take a look at what's driving the price action today. And you can see small cap stocks have been the best performer over the past couple of weeks, and continues to be the case today with a small gain. You can see some other small gains on bonds. In fact, all U.S. assets are doing really well. You have the dollar, you have the S&P 500, the small cap index. You have high yield here in pink, high yield bonds, which can mimic stock movements. You can see preferred stock here in purple. You also see long-term treasuries here, all of these. And finally, crude oil starting to bounce off of that. That's the bounce we were looking for, whereas commodities and foreign assets all lagging behind. So they're developed. There's EFA right there. There's EEM. EEM had a bad day today. There's EFA. Both of these struggling and relative to the S&P 500. And of course, your foreign bonds also being weak here, with gold prices kind of matching the returns of the dollar over here. And the dollar had that strong finish to the week last week, and that put pressure on gold. Gold here in red, so you can see the pressure put on gold Crude oil also was pressure, but it started to bounce. So again, I see this strength in the dollar kind of temporary, and you'll start to get some bounce back, especially in areas like EEM, which really has been hit hard, and agricultural commodities with these tariffs. That they've been kind of sold off here, and we'll see if they end up bouncing back up, especially if there's any kind of that this is kind of a knee-jerk move on the dollar, and the dollar starts to pull back again. News was light on the economic calendar. Tariffs still kind of a lingering thought in investors' minds. The housing market index is a sentiment survey for home builders. You can see pulling back a little bit, far less than the consensus. So continuing to have show some weakness there. An impact in the economic supplies index, but not very much. You can see it's still positive at 12.2. Far better outlook than what you see going on globally. Odds of a rate hike in December, pulling back, still above 50%, but pulling back from where they were last week after the FOMC meeting. The GDP estimates not being raised today. They'll be updated tomorrow. We'll see, and you can see the trend continues to point to the upside. So a good move for the economic indicator. Again, kind of showing why U.S. assets are doing so well compared to, even with rate hikes on the table, compared to globally. Especially the small cap stocks, which don't have the exposure to the currency risk nearly as much as a lot of these large cap multinational companies do. All right, from the sector rotation standpoint, I've ordered the charts here by how they performed today. Of course, in the after hours, S&P 500 down a little bit. You can see here down about a point in the after hours with the tariffs, with potentially $200 billion more of tariffs. So keep that in mind. That's not taken into account here on any of these ETFs. This is all how they performed with today's close. Also going back to keep in mind that get moved down to 275.50. Where does that line up here with the? Well, let's just go to this chart here really quick so I don't mess up those sector charts. That would bring us down to where we opened today. And remember, that was around that 23% Fibonacci retracement level. So just to kind of give you some perspective on even the overnight selling and what that's doing. All right, but you can see energy was our big bounce back mover today. It's got a bearish posture right now, and it's strongly bearish. It's gotten below 50. See, these other bearish postures are all above 50 in materials and financials and real estate. This one has gone below 50. And it's also got a green moving average line, which means it's rising, but we're below it. And you can see, we've got a few other yellows. Most of them are green. We're rising above that. You'll see that the industrials will turn yellow tomorrow as we are below it there. But the rest of them are still above. A lot of these up above their moving averages. You can see utilities, also a good performer today. Not the stock that we looked at on Friday yet, but at least the sector is continuing its bounce back up with a rising moving average. Some of these others, you can see technology, discretionary. These five right here all outpaced the market. And technology and discretionary still have that strong bullish posture, still above rising moving averages. They continue to be good market leadership. You can see utilities and energy are kind of on the flip side of that midpoint. We've got a weak bullish posture. You got a stronger bearish posture. So neither one of those two are looking good from the intermediate standpoint. On the other end of the spectrum, staples, which had been solidly bullish, potentially starting to roll over a little bit from what can be a lower high point. So we'll see if today's down day coming off of Friday's overbought cluster is a sign that we'll get a short-term pullback. Not that we'll get a pullback to lower lows. Of course anything can happen, but we've been so bearish on that stock. It's hard, we didn't come off of a higher low point. We didn't form a higher high point yet. We could very well either form a higher low at this moving average and any kind of pullback, or at least an equal low point that can serve as a double bottom. So we'll keep our eyes on staples, but it looks like it's starting to fall. Healthcare also had a down day today, but a pullback day. Still got a strong bullish posture and pulling back, and that's been an area that we've looked at too in the past for trade ideas in this video. Actually is where we're going to go with today's video. You can see the Merck, one of the big companies within that sector, has been on a good bullish trend. It's been forming higher highs, higher lows. It met up with some resistance at this 62.5 levels. Not surprisingly, an old high point over here, some old lows over there. You can look back over a couple of years for some perspective on this. And you can see why it kind of met up with some resistance on its first foray to the 62 level, and we're pulling back right now. And the pullback has actually formed an intermediate confirmation signal, a strong bullish posture. Yes, it's falling, but still above 80. So you got a strong bullish posture, slightly oversold momentum line that's not too extremely oversold, and enough of a pullback here to bring that near-term line down below 50 and set it up for a higher near-term bullish low point. You can see also if I draw the Fibonacci lines here from that low to that high, we're sitting right about the 38, and a low today sitting at that old high point here, which also happens to be the 50% Fibonacci retracement level. So, a good opportunity to do a bullish trade. Now the market's kind of wishy-washy, right? Are we getting enough of a pullback? We haven't yet on the small cap, so we're not aggressively bullish, and that's the beauty of options trades. We looked at a stock trade on Friday for potential for a trend trade. We did that before with Harley-Davidson here recently. In this particular example, we can look at a stock. We'll look at a trade opportunity for Merck and say, okay, here if I look at, they've got 50-cent wide spreads. But if I go to the $2 wide, I'm a little high on the I'm a little high right now on the credit, a little bit more than what I need for a $2 wide spread to get a 30% return on risk. Because remember, the higher the credit, the lower the probability of getting a return. The lower the credit, the higher probability. And probability is what we're shooting for to an extent, and that extent is 30% return on risk. And you can see we're getting a pretty decent return there. If I were to analyze that trade and show it here on the chart, we'll set slices of break even. You can see there's decent probabilities. Our break even point would be at $60 in that case. Remember, the stock would have to bounce up to 61 and a quarter for that trade to fill. And then you look at, okay, where would that slice be? It would be right at that support. So there'd be plenty. You get Fibonacci support. You have the moving average. You have these old high points would all be helping to keep it above that level. And it's right when you get to a little bit below that level is where you'll have a $47 loss, which we would take because we would know that, I don't want to get anything bigger than that. I want to take, take small losses on these types of high probability trades so that we can avoid the big losses that are much, much harder to come back from. We can always live to trade another day there. And you can see, today's high point was 61.36, so we'd have to kind of get going again and have a decent chance, and this bullish signal would play itself out for us to get into the trade. And of course, it would have, once we are in, it has a decent probability of success there. So what do you think about taking advantage of the pullback there in that strong sector, in the healthcare sector on this particular stock? On Merck with that higher probability bullish strategy, option strategy. Let me know in the Market Outlook forums there on marketscholars.com. Remember, I showed you earlier how to be able to participate in that. Let's chat about the trade idea tonight. Let's chat about the market posture and what you're seeing here, and things that might be standing out to you or not, or anything that stood out to you from tonight's video. So love to hear your thoughts. Remember the link to the forum is right above the video if you're watching this embedded in the blog. Remember to subscribe to our YouTube channel, like tonight's video, and comment on anything that stands out to you. Follow on Twitter for more content like this. Join the Market Outlook community on Facebook. Have a great evening, everybody. Thanks again for watching. We'll see you all next time.